Hey, welcome to this market and economic update. In this video, let's discuss some perspectives on the second half of 2025. The first half of the year has tested many investors. S&P 500 is finally making its way back positive, but we've had trade wars, market corrections, geopolitical tensions, a lot of stuff going on. But beneath the challenging headlines, there does lie some important facts about investing, which is that uncertainty often creates the very opportunities that reward patient long-term investors. So over the next few minutes, we're going to explore 5 insights that can help provide perspective in the coming months. So let's get started. All right, so let's start by looking at how markets have performed as we begin the second half of the year. So this chart shows the dramatic contrast between first and second quarter performance, highlighting just how quickly markets can recover when conditions do improve. From the market's perspective, recent trade agreements have taken the worst case scenarios off the table, and the round trip for major indices was one of the fastest in history, with the S&P 500 returning to a starting level by mid-May. So the key takeaway for investors is that markets are forward-looking and capable of adapting to changing conditions faster than many expect. So this is why jumping in and out of the market can be very difficult to get right. You have to be right twice. So while there's never a guarantee of quick recoveries, focusing on underlying trends rather than daily headlines helps investors stay positioned for when markets do improve. Next, this Israel-Iran conflict has dominated the headlines recently. It seems like there's a solution, but the situation is still evolving, obviously. But the thing is, history can teach us some valuable lessons. This chart shows an important historical pattern. Markets generally recover, whether it's a geopolitical shock or whatever else is going on. The way I like to think about markets is when everything's going good, it's like you walk out to one of those lakes where it's just still, it's like glass, you have a reflection in there. And then anytime there's a significant event, like a war or some sort of crisis, it's almost like you take a big rock and you throw it out. And that rock, when it hits that spot, you're going to see the waves going out. And when it first hits, you're going to see bigger waves, right? So that's when you see the market go up and down a lot more. But as time goes on and those waves get further out, they usually decrease as well. And that's how the stock market responds. One noteworthy thing today in this time is the muted response in the oil market. So people are very concerned about the oil market. We'll see what happens with Iran. But despite concerns about potential disruptions to oil supplies, prices have only increased to where they were a few months ago. So this stability suggests markets are taking a balanced view of the situation. History does show that underlying market conditions and economic trends matter more than geopolitical events themselves. That's very true. The Gulf War occurred during the 1990s tech boom, for instance, so markets actually performed well over that period. So while the situation is still changing, it's important not to overreact to the news headlines when it comes to geopolitics. The brightest spot in today's environment is the remarkable resilience of the U.S. economy. So this chart shows that the most inflation measures are well below 3%. Meanwhile, unemployment remains near historic lows at only 4.2. So this is where, I don't know if there's an argument to be made that rates should be dropped, okay? But while first quarter GDP did contract by only a fraction of a percent, the details show this was largely due to trade disruptions as companies stockpiled imported goods ahead of potential tariffs. So consumer spending, which is the largest component of the economy, still grew steadily. The economy's stability during a period of uncertainty is positive for corporate earnings and the overall stock market. Perhaps the biggest challenge for investors is that the U.S. stock market valuations have returned to historically expensive levels. But U.S. stocks are attractive. That's part of the reason why. Fortunately, this environment has created compelling opportunities in other areas of the market. So this chart demonstrates how international stocks have performed well this year across developing and emerging markets. Emerging markets have done 12.3% year to date. Really amazing year to date for emerging markets. And when I say emerging markets, what I mean is countries like Colombia, India, Vietnam, those type of countries. And then the developed markets here have done 16.3%. So developed international would be companies like Shell Oil, Nestle, Toyota, those type of companies, right? So well-known companies, but 16.3% year to date. International has really been struggling the last number of years. It's done okay, but US has just done so well that's really overshadowed it. So this pattern serves as an important reminder that market leadership rotates over time. Whether it's a US large cap stock or Magnificent Seven stock, it's important not to have a narrow focus on our asset allocations. All right, finally, this last chart focuses on perhaps the most important principle for investment success: maintaining a long-term perspective, right? So this chart shows if you go over a long enough period of time, you're not going to lose money in the markets, right? I should say you haven't in the last 100 years, right? So if you look at the 20-year time period here, there's been no chance of loss, even at 100% stock allocation. But if you're in retirement, for example, you need to have a more consistent income. You can't have a 41% downturn and still draw to your portfolio and have a high percentage of probability of success for most people anyways. So this chart illustrates how investment returns have behaved over different time periods, showing that while annual returns can vary dramatically, they are smoothed out with enough time. This historical pattern explains why stocks and bonds have served as the foundation of long-term portfolios for generations of successful investors. And something someone said recently that I just want to remind you of is if you're buying stocks, if you're investing in the market, this should be something that you're thinking about just owning forever, right? You're going to pass this on for generations. This is generational wealth. Maybe you'll spend it all, but more than likely you won't. As we get into the second half of the year, we just want to be thinking long-term, make sure we're staying diversified and making sure we're not getting caught up in any of the media hype. That's a big thing. Okay. So I hope you found this valuable. If you have any questions about your retirement planning, your investments, your tax planning, or any sort of financial planning, please don't hesitate to reach out. The link to schedule a meeting is down below. I look forward to speaking with you and I wish you the best. Have a great day.